Welcome to the deep dive. Today we're tackling commercial real estate syndication.
Sound good.
Our roadmap is Join the Property Party. Syndication 101 by Cara Conde, dated April 3rd, 2025. This guide really aims to break down how multiple investors can, team up to buy these big commercial properties.
Right, like office towers, retail centers, things most people couldn't buy alone.
Exactly. So for you, the learner, our mission is pretty straightforward. Extract the core concepts, show you how it works, the potential rewards, but also, crucially, what you need to watch out for.
Yeah, definitely. Cara Conde, who calls herself the best commercial real estate agent, lays it all out. We're here to distill that, make it understandable so you can see if it's maybe a pass for you without getting bogged down in jargon.
Okay, so let's start simple. What is commercial real estate syndication in plain English?
Well, think of it like a group buy, but for massive properties. Instead of one person needing, say, $20 million for an office building, a group pools their money together.
Ah, okay, so it's collaborative.
It's exactly. Collaborative investment. It lets regular investors access these high-value assets. Office towers, shopping centers, big apartment complexes that they just couldn't afford on their own. Conde really emphasizes this accessibility point.
Interesting. So who are the main players in this property party, as she calls it?
There are basically three key groups. First, you've got the sponsors. These are the pros, the syndicators. They're the ones finding the deal, structuring everything, raising the money, and then actually managing the property.
Right. The boots on the ground, handling tenants and repairs and all of
The
that.
whole 9 yards, yeah. Then you have the investors, and that could be you, the learner.
Mhm.
You provide the capital, the cash. In return, you're a passive owner, hoping to share in the profits.
Passive sounds good. And the third?
The property itself, of course, the actual commercial asset. Could be a Class A office space, an industrial warehouse, a multifamily building. That's the engine generating the potential returns.
So this isn't really like flipping houses we see on TV. It's bigger scale commercial stuff.
Definitely a different league. And Conde highlights that syndication massively lowers the entry barrier. You don't need millions yourself. Maybe, $50,000 could get you a piece of a very large pie. She positions herself as the expert connector for these deals.
Okay, I get the concept pooling money, but walk us through the process. How does a deal actually happen from start to finish?
It kicks off with opportunity sourcing. The sponsors are always hunting for properties with potential. Conde gives an example like a $15 million apartment complex in a growing suburb. Low vacancy rates look solid. They dig deep into market trends, the property's financials, all that due diligence stuff,
They find a gem, then what? Make it official.
pretty much. Next up is the legal framework. The sponsor sets up a specific company, usually an LLC, limited liability company, just to own that one property.
Ah, so the investors aren't directly on the deed.
Right. The LLC owns the property. This structure is really important. It protects the investor's personal assets and spells out the rules of the gain-profit splits, voting rights, everything. Conde mentions working with lawyers to ensure compliance with SEC rules, specifically Regulation D. That governs these private investment deals.
Okay, legal structure in place. Now they need the money, right? The investor's capital.
Exactly. That's the capital raise.
Yeah.
The sponsor markets the deal, presents the business plan, the projections to potential investors. They need to raise enough for the down payment, closing cost, maybe some funds for initial upgrades.
Like in that $15 million example, how much would investors need to bring?
Well, if they got, say, a $10 million loan, they need to raise the other $5 million from investors. Conde mentions minimum investments often range from maybe $25,000 up to $100,000, sometimes more, sometimes less. Depends on the deal.
Got it. Money's raised. Time to buy.
Yep, acquisition time. They close the deal, buy the property, then the sponsor immediately shifts into management mode. That's ongoing. Renovations if planned, leasing units, dealing with tenants, optimizing income, cutting costs where possible.
Making the property perform better, like Conde's example of raising rents after upgrades.
Exactly. Maybe bumping rents 10% after renovating kitchens or something. It's all about maximizing that cash flow.
And that cash flow, that's where investors start seeing a return.
That's the goal. Which brings us to returns and exit. Investors typically get paid regularly, maybe monthly or quarterly, from the property's net rental income. Conde mentions an example like an 8% preferred return, sort of a first dibs on profits up to that percentage.
Okay, so regular income, hopefully, and then what happens down the line?
After a planned holding period, usually like 5 to 10 years, the sponsor aims to sell the property, the exit, ideally for a profit.
Ah, depreciation part.
Right. And those profits from the sale, after paying off any remaining debt, are distributed. There's a pre-agreed split. Conde gives an example. Maybe 70% of the profit goes to the investors and 30% to the sponsor for making it all happen.
So if that $15 million place sells for $20 million later, that $5 million profit gets split 70-30.
Basically, yes, after settling debts. Plus, Conde points out the tax benefits. Things like deducting depreciation, mortgage interest. These can shelter some of the income. And she mentions 1031 exchange as a way to potentially defer capital gains taxes if you roll the proceeds into another similar investment property. She stresses finding sponsors with good track records here.
Okay, that sounds, well, pretty appealing on the surface. What does Conde list as the main advantages for investors?
She breaks down several key benefits. The big one is access to premium properties. Like we said, you get a slice of a $10 million office building or a $25 million industrial park, assets you just couldn't touch alone. A $50 K investment gets you in the game.
Definitely opens doors. What else?
Passive income. This is huge for many people. You get potential cash flow without being the landlord. No calls about leaky toilets at 2 a.m.
Ha! The dream. Mailbox money.
Kind of, yeah. Then there's portfolio diversification. Commercial real estate often moves differently than stocks or bonds or even residential housing, so adding it can potentially lower your overall investment risk.
Spreading the risk around. Makes sense.
Uh-huh. And professional management. You're leveraging the sponsor's expertise.
Yeah.
They handle the complexities. Conde says she recommends top-tier sponsors, people who really know what they're doing.
So you don't have to become a commercial property expert overnight.
Not at all. You rely on them.
Yeah.
Then the tax advantages we touched on, depreciation, interest deductions, maybe 1031 exchanges, these can really boost your after-tax returns.
Right. Taxes always matter.
Always. And finally, the potential for high returns. Conde talks about combining the ongoing cash flow, maybe 8–12% annually, with the profit from appreciation when it sells. This can lead to, potentially strong double-digit returns over the life of the investment. She gives an example where $100 K might grow to $160K over 7 years. She emphasizes matching deals to goals, income, growth, or both.
Okay, that paints a rosy picture. But let's get real. What are the risks and challenges? What could go wrong?
And Conde is clear about these, which is important. A major one is illiquidity. Your money is locked up, typically for 5, 7, 10 years, maybe longer. You generally can't just pull your cash out if you suddenly need it.
So definitely not for short-term cash needs. It's a long game.
Absolutely. Set it and forget it, she kind of implies. Then there's sponsor risk. Your returns really depend on how well the sponsor performs. If they mismanage things, make bad calls, or just aren't good at executing their plan, your investment suffers.
So vetting the sponsor is critical. It's not just about the building.
Hugely critical. Conde stresses checking their track record, their transparency, their specific expertise. Then you have market volatility. The economy tanks, interest rates shoot up, a big local employer leaves town.
Right, things outside the sponsor's control.
Exactly. These can hit occupancy, rental rates, property value, like an office building suddenly having huge vacancies if a major tenant leaves. That hurts cash flow.
Okay, what else?
Fees and costs. Sponsors get paid, obviously. There are acquisition fees, asset management fees, maybe a percentage of the rental income, and that profit split at the end. You need to understand all the fees and make sure they seem fair. Excessive fees can really drag down investor returns.
Gotta read the fine print on fees.
Always. And finally, regulatory risks. These deals fall under SEC rules. Non-compliance is a big problem. Conde mentions Regulation D, with its different flavors like 506B or 506C, which impact who can invest and how the deal can be marketed. She emphasizes her role in due diligence here, reviewing business plans, projections, cap rates, cash-on-cash returns to ensure it aligns with the investor's risk profile.
Okay, lots to consider. So with these pros and cons, how does someone figure out if syndication is actually right for them?
Conde lays out the typical ideal investor profile. Often, because of SEC rules, it leans towards accredited investors.
And what does accredited mean again?
Generally, it's someone with a net worth over $1 million, not counting their main home, or income over $200,000 a year for the last 2 years, $300,000 if filing jointly.
So a certain financial threshold.
Usually, yes. Though she notes some deals, these 506B ones, might allow a few non-accredited investors if they have a pre-existing relationship with the sponsor. But beyond accreditation, you need a long-term mindset and be okay with moderate risk.
So probably not for someone saving for a down payment next year or someone who wants zero risk.
You're generally not, no. Conde also says think about your goals. Are you after that steady passive income stream? Or are you more focused on building wealth through the property appreciating over time? Your priority shapes the kind of deal you look for.
Income versus growth.
Got it. And how does this stack up against other options, like REITs, or just buying a rental house?
Good question. Conde compares them. REITs, real estate investment trusts, are easy to buy and sell on stock exchanges, very liquid. But returns are often lower, maybe 4-6%. You have less control, and you miss out on some direct tax benefits, like depreciation pass through.
Okay, more liquid, maybe less return. What about owning property directly?
Direct ownership gives you full control, but it's way more capital intensive. Even a small commercial property might need $500 or more upfront. And it's very hands-on management unless you hire pricey property managers.
Right, that late night plumbing call problem again.
Exactly. And then there's crowdfunding. Online platforms offer lower minimums, maybe 5K, 10K. But Conde suggests fees might be higher, and transparency could be less than, with a well-vetted syndication deal where you really know the sponsor. She positions her own consultation service as a way to figure out the best fit.
Okay, so let's say someone's listened, they fit the profile, they're interested. How do they actually get started finding and investing in a deal? Conde outlines the steps. First, find opportunities. This could be through networking, checking out online platforms like CrowdStreet or Realty Mogul she mentions, or working with someone like her who might have access to off-market deals and connections with trusted sponsors.
That access seems valuable, potentially finding deals before they hit the open market.
It can be, yeah. Once you find potential deals, the absolutely critical step is conduct due diligence. Don't skip this.
What does that involve specifically?
It means digging into the sponsor's track record. Have they done deals like this before? Were they successful? How's their communication? Conde says she provides references. Then scrutinize the property's financials. Look at their projections, the pro forma. Understand the net operating income, NOI, the cap rate. A 7% cap rate on a $10 earned property means $700 in NOI, for instance. Look at the cash-on-cash return projections.
So really kicking the tires on the numbers.
Definitely. Also, market analysis. Is the area growing? What are the job trends, population growth, rental demand like? And crucially, review the legal documents. The Private Placement Memorandum, PPM, outlines the terms, risks, fees. The operating agreement details profit splits, decision-making. Read it all carefully.
It sounds like homework is required.
Absolutely essential homework. If everything checks out and you're comfortable, then you take the leap. You might need to verify your accredited status, sign the subscription agreement saying you want in, and then wire your funds, usually to a secure third-party escrow account.
Okay. And after the money's in?
Stay informed. Understand the legal side, like whether it's a 506B or 506C offering. Understand the tax implications. You'll likely get a K-1 form each year for taxes. Consider consulting a CPA. Conde emphasizes she guides clients through all these stages.
Her guide also has that people also ask section. What quick answers does she give to common questions?
Right, like minimum investment. Typically $25K or $100, but varies. She says she can help find options. Earning potential. Reiterates that 8-12% annual cash flow plus potential profit at sale. Gives an example. $50 K might yield 4K, 6K a year, plus maybe 30K profit if the value doubles over, say, 7 years.
Okay. And the risk question?
Is it risky? Yes, she acknowledges market risk, sponsor risk, illiquidity, but stresses her role is minimizing risk through vetting. People also ask what she does. She clarifies, connecting investors with sponsors, aligning deals with goals, providing advice, and the non-accredited investor question. Possible in some 506B deals if you have that pre-existing relationship with the sponsor. She can clarify eligibility.
It helps to see it in action. Conde includes a case study, right? Can you walk us through that success story?
Yeah, it's a good example. The client is Sarah. She invested $75,000 back in 2018, mainly looking for passive income. Through Cara Conde, she invested in a $15 million multifamily property deal in Austin, Texas, with a sponsor Conde recommended. The deal terms were a 5-year planned hold, a 9% annual preferred return to investors, and that 70-30 profit split upon sale.
And what was the sponsor's plan for the property?
Their strategy was value add. Renovate units to justify raising rents by about 12%, and also improve management to boost occupancy from 90% up to 95%.
Did it work out?
According to the case study, yes, the property performed well. Sarah received her 9% preferred return each year, which was $6,750 annually on her $75K. Then, in 2023, after 5 years, the property sold for $22 million.
Wow, a $7 million gain from the $15 million purchase price.
Right, so after debts, etc., there was significant profit. Sarah's 70% share of the investor profit pool came out to $87,500.
So adding her annual returns plus that profit share?
Her total return was substantial. Her initial $75,000 grew to $121,250 over those 5 years. That's about a 61% total return. Sarah's testimonial in the guide credits Conde for finding the deal, vetting the sponsor, and making the process understandable.
That's a tangible example of how it can play out well. All right, let's wrap up this deep dive into Cara Conde's Syndication 101. What are the main takeaways for the learner?
Well, the big picture is that commercial real estate syndication is a mechanism, a tool, that lets individual investors team up to buy large, potentially high-performing commercial properties. It offers possible passive income, portfolio diversification, and significant long-term returns.
But it's not without complexities and risks.
Absolutely not. Condi's guide walks through the process, finding deals, legal structures, management, the exit, and highlights the benefits like access and professional management, but also underscores the risks like illiquidity, sponsor performance, and market shifts. Due diligence is paramount. The case study shows the potential upside when things go right.
Okay, and that brings us to our final thought for you, the learner. Syndication basically uses collaboration to unlock access to big-ticket real estate. It makes you wonder, what other traditionally exclusive investment worlds could be opened up using similarly group investment models in the future?
Hmm, interesting point. Could we see more pooling for things like venture capital startups, maybe large infrastructure projects, or even, I don't know, fractions of high-end art or collectibles?
Exactly. It's food for thought. If you want to dig deeper into syndication itself, Cara Conde's website is referenced in her guide. You can also check out SEC resources on Regulation D or platforms like Realty Mogul that she mentioned. Hopefully, this deep dive gave you a solid grounding to explore further if it sparks your interest.